Boy, I'm giving away the farm here. So I've got an hour update seminar here for you. Those that attended live got 617 pages, my full 8 hour of materials. But I didn't just go over what we need to focus in on for year end planning, small businesses and tax professionals. And those that I invited are on my newsletter list. And so, with that, if you'd like to be on the newsletter list, well, there's a link in the body of the video to sign up. Not only would you get invitations to private Zooms, I include Q&A live, as well as giving them those documents to follow along, the 617 pages. So if you would like the 617 pages, follow along with this video, well, then sign up for my newsletter. Hey, listen, I've also got a mastermind group that I've put together. Check it out as well. All right, hey, let's get into this year-end tax update. Just know this, I shouldn't even be putting it out here for free, but that's just how much I love you. So if you're not a subscriber and you're getting ready to watch, do me a favor and hit subscribe, like, and comment, share this, and show a little love. All right. All right. Well, if you don't mind, I wanted to just tell you briefly, since you're all here for free, we always know that there's always a catch, right? Well, I don't mean for there to be, but I've got a mastermind. I've had various different groups throughout the year, but this is a group that we're going to have through April 15th, and this is a roundtable. It is a group of small business owners and tax professionals, and we're exclusive in the sense that we have a tight knit group that once we get going, then we're able to talk about what's going on in our businesses right now and troubleshooting. We have a meeting about every 10 days, and really it's straight up Q&A. We've got a private app that we can do Q&A in between and share updates. I start each meeting with just a quick update. You'll see on the page where you got these materials, the update I gave everybody yesterday. And I do some tax workshops just as we go along. It does not include CE, but it's real time. And this is kind of meant for those that are like me. They're a solo practitioner and or a small practice, and they need somebody to be in the boardroom with them. So with that, let's go ahead and get underway. Of course, what we're presenting today is for informational purposes. And for those people that are jumping on right now, you should have a copy of the materials. There's 671 pages, so you're right, we're not going to be able to cover 671 pages. So, going to talk about some basics here. And for those that are small business owners, you don't always want to do just the traditional year-end planning. Same thing for us as tax professionals, talking with our client, but really it's looking at what are your bills due right now? Like what's just due? Instead of looking at, well, what else can I spend money on? It's just, well, what do you owe now? And are there some expenses that you're going to owe in early January? Would it make sense to pay it before year end? Making sure you're running your last payroll before the end of the year so that if the employees get paid this year, then you get to write that off. Currently, we've got real estate taxes that are probably due across the board for everybody. And then making sure that you're maxing out your retirement withholdings. Now, one of the big things, I just came from a meeting with a client, and they're having a down year. We've got some unusual losses. And so we're not doing any of this at year end. We're not wanting to prepay. They're actually taking expenses. And if they don't have to pay them in December, they're going to pay them next year. So the key here is you need to know, well, what does your year look like? And for individuals, not a lot that can get done if you are itemizing, looking at your charitable contributions, cleaning out the closet, if you will, getting those receipts. And then do you want to consider paying fourth quarter if you have state income taxes before year end so that you can be in a situation where you're able to maybe get that as an extra itemized deduction? Now, just as a reminder, when you spend a dollar, it doesn't save you a dollar in tax. And, it's interesting. I've had clients, well over 29 years now, and it seems like we still have to go over that concept and remind them that, yes, when you spend a dollar, it's only going to save you a percentage of that. So you never want to spend money just to spend money. and to deduct any expenses in 25, if that's what we're ultimately wanting for you or your client, then those need to get paid by the end of the year. We do remind clients that on credit card charges, as long as the credit card is charged before the end of the year, you got a receipt, then that's the year it's going to fall into, meaning 2025. It doesn't matter that you pay the credit card next year. What's going to matter is, well, when did you charge it? So, what doesn't help taxes is paying off debt, paying off car loans, paying off lines of credit, paying off credit card balances. And the reasoning for that is that when you actually borrow this money or you use the credit card or take an advance on a line of credit, that's not a taxable transaction. So when you're paying it back, you don't get a tax deduction. So while it's good to pay off debt, I'm just saying it doesn't help for tax purposes. So you want to make sure that your money's going where you want to have that benefit. Also, if you're trying to purchase a vehicle before year end, just take note, you do need to take it in possession and make sure you've got the paperwork on there. And remember, the purchase price is your tax deductible amount. Now, if you've got a trade in, if you've got down payment, that doesn't necessarily change the purchase price. So, what you want to pay attention to, though, is well, how much of that are you getting as a deduction? What does it qualify for? And only to say, don't buy a vehicle just for the tax deductions, but if you are, then make sure you're aware, is it over 6,000 pounds GVWR? Or is there going to be any additional benefits to just waiting till next year? So I think we're all on. I know we've still got people coming on. Of course, JJ, the CPA here for small business owners. We're going to cover a lot of different things, but we also have tax professionals on here. So renew your PTIN. Make sure you update your WISP, your written information security plan. All tax preparers are needing to do that before year end. Now, there's 617 slides, so you'll just need to keep up because we're going to be going through the slides, and I'm going to stop where there are minor, issues that we want to talk about before year end. So the state of the IRS, here's all you need to know. The IRS is still here. Yes, it has less employees, but that doesn't really change anything. So we still want to follow the rules and regulations. What we've got coming into play for 2025 is a number of new issues. We are going to dive down into a few of those, but the standard deduction did go up. The child credit went up $200. The adoption credit's now refundable starting in 2025. You want to be aware of these things for year-end planning and then also during tax season, being familiar with these things. Some of this can make a difference in your tax planning at year end. Maybe adoption is not as often, but the child tax credit being increased. Also, when we're now looking at Trump accounts, I've got a couple of videos that just came out related to this, but here's all you need to know. There's not anything anybody can do right now until mid 2026. However, what you should take note of is there's a brand new form 4547, and that is something that is filed with the tax return. So we got to be aware of what our clients are needing. Now, for the no tax on tips, I am going to go through it in detail, but it's up to $25,000. That's per return. That means that single gets 25,000, married filing jointly gets 25,000, head of household gets 25,000, but it's only going to be to the extent of cash tips that are recognized as income. Take note, rarely we would ever see this, but married filing separately yields a zero deduction. And this has to be then identified as tips. One of the big things is voluntary tips only get included. So if there's tips paid that is, well, for parties larger than 8, they automatically add a tip. Well, technically those tips don't count. $10,000 deduction on auto interest. The IRS indicated that those companies that are collecting this auto interest that then qualifies, they don't send out the form. We don't know what that form would be. We're going to guess a 1098. But here's what you need to know is that when we get into January, you are not going to find per se anything designating the number of tips. You're going to need a report from the employer. Now, I get it on the W-2, You can point to a box that shows tips. Great. Point is, that doesn't necessarily mean those are the tips that qualify. So you need to let your clients know now, or if you have tips, you need to be asking your employer, because what the IRS said is that the employer needs to provide a statement. We don't necessarily get to rely on the W-2. And then for that auto deduction, we're not going to know if our client's got a new auto, especially if it's owned personally, because that's only the aspect that's being covered here. But it does have to be on a brand new vehicle. Now, on overtime pay, there is 12,500 that is now not taxable, but really that's a deduction. So just like tips, you got to recognize all of the overtime pay. Now it's 12,500 per person, so married filing jointly would get up to 25,000. Not sure why, but married filing separately is a zero deduction. Also for 25, $6,000 deduction for seniors age 65 and older on the last day of the year. And if you have two that qualify, then that's $10,000. So I do have in January, I'll be letting you all know, I'm going to have a longer version going through a number of these details. But the reason I'm including these items in the year-end tax update is that it does potentially make significant differences in how year-end planning is done, especially for those that are employers, making sure that they are aware of what needs to be put together. Now, on that $6,000 deduction for seniors, they just get it. They get it in addition to the standard deduction. They get it in addition to the existing senior deduction, the existing blind deduction. If they itemize, well, they get it on top of the itemized. So it's a stackable deduction. But married filing separately is a zero deduction. Now, on the SALT limitation, yes, it is up to 40,000, but there is a modified adjusted gross income phase out, 500,000, and that phase out is the same for all filing. So for single, married filing jointly, for head of household, it's all 500,000, and you start losing that very, very quickly. So you definitely want to pay attention and not just assume that somebody's going to get more than a $10,000 deduction. Now, there's some things here that I'm not going to press upon just because it doesn't really affect us at year end. And so I am going through. And what we want to know is that if we've got clients that had the clean vehicle credits, well, those expired September 30. We still have to report those on the tax return. So if you or your client got the credit before this expired, you still have to reflect that on the tax return. Energy efficient home improvement credits, well, those are ending at the end of this year here in a couple of weeks. So probably might be too late to run out and do any of that, not big dollars, but we would want to be sure that everybody's aware they're ending so that they don't have this fall into the next year. Now, I'm not going to go through 2026, but you have it included in there because we're talking about year end. Now, for businesses, great news related to those that have new assets. We have bonus depreciation, 100%. Now it's acquired after January 19th, 2025. This is not back to 1/1/25. So technically assets that were 1/1/25 to 1/19/25 would be at the 40%. 1099K threshold reporting, that's 20,000 or 200. 179, we know we get to deduct that dollar for dollar as well. That has been increased. The $2.5 million, that is effective back to 1/1/25. They know that there's some differences there, but one of the things I was just visiting with clients about this week is that you now can make some decisions on how you want to depreciate things when you get to tax time, but we at least would want to know, well, what is available to us? So employers must report and track the cash tips and that overtime, so they need to be prepared for that. All right, so we talked through this on the business provisions. We're going to keep going. Now, on the tax rates, this is for 26. We're still using the same bracket. So you know this, when we hit January here in a couple of weeks, we've got to be looking at, well, what does 2026 look like? So now we know, that's good to know. Here's what's interesting. We have the higher standard deduction, in fact, for 2025. So after the new law went in play, it went up $1,500 for married filing jointly. So that's a good thing there. And with the SALT increase, yes, it went up to the 40,000. We're going to go through a detail on how quickly it reduces down. So basically, when they're over 600,000, they're now down to only being able to deduct 10,000. So that can make a major, major difference when it comes down to getting that deduction. So on that SALT, I've got an example here for you. And with that, I'm putting examples in here for you to go through. So we're not going to take the time to go through our examples here. Now, we know that the SALT limitation is going to go away of 40,000 and it'll be back down to 10,000 in 2030. So here's just an example that somebody's only above the threshold by 50 grand. Doesn't matter if you're single, married, filing jointly, head of household, and they lost $15,000 of that deduction. So we've got these phase outs related to SALT, the charitable, the allowable itemized deductions. So got some additional limitations that are coming into play. Definitely want to figure out, does that pass through entity tax election still make sense going into the next year? I know in the state that I'm in Oklahoma, if we're going to elect it for 2026, we have to elect it by February 15th of 2026 to be effective for 2026. So it's definitely worth taking a look at that. Again, depending on when you came in, these are going to be 617 slides that cover my 8-hour course. So if it's related to 2026, you got it to read later. If we've got examples, we're going to go through that in my longer version of these when we do that in January. So you just have access to this. So excess business losses, we still have those in play. Just take note when you're looking at your carryover excess business losses, those become NOLs, right? And NOLs are limited to 80% of taxable income. So depending on what's going on this year, but then take note, excess business losses, that limitation is a reset button in 2026. It goes back to what it was in the first year this was put into play in 2018. So that's a major factor if you're now looking at taking advantage of max losses along with your basis. HSA with the new law, and the IRS just came out with a clarification, I think Monday, talking about that there are more plans that qualify for that. Moving expenses continuing to not be deductible. The child care credit, what we're seeing here is that that's related to 2026. But for most, if they have the opportunity to run it through the employer, that goes up to $7,500 starting in January in a couple of weeks. So we want to make sure going into year end, going into next year, our clients are aware of that. Now, I did run some examples here for you that shows you, well, is the credit better or is the deduction better through the cafeteria plan? With this, the adoption credit, this starts in 25. It is refundable. The first $5,000, you still have that same dollar amount of $17,280 of the credit. Just the first 5,000 of it is a refundable amount, and then it'll carry over still for 5 years. So I've given you some examples here related to that. And with 529 plans, given that that's not really anything that affects federal, just be sure you're paying attention to it for the state level. Not going to talk about the Trump accounts because those really are not anything affecting taxes, but take into account there is a Form 4547 that is in play. Just can't file it just yet, but it does go with the tax return or it can be filed separately. Clean energy provisions, all you got to know is that they either came to an end or they are coming to an end. Now, I want you to take note that these new deductions that we've covered are the below the line deductions. So there's a big key distinction here. And we know that it's 100% that. So I've taught some seminars here recently, and for some reason we still get in discussions about this, but the IRS just came out here recently with Form 1A, and 1A does not go on Schedule 1. Schedule 1 is a deduction to arrive at adjusted gross income. A below the line deduction is like QBI or like the standard deduction or itemized deductions. It's a deduction after you determine your AGI. And because these new deductions are contingent on either AGI or modified AGI, these are 100% below the line deductions. But that's a good thing when we're doing our planning. So all of these new things, the senior deduction, the tips, the overtime, and the car loan interest, that's all for 2025. The charitable contribution, that new one, not going to talk about it because it doesn't start until 2026, but that's also below the line. So what does that really mean? Well, for those that are like, well, what's that terminology? Well, on a Form 1040, excuse me, you will see that your adjustments from Schedule 1 then arrive at your adjusted gross income on line 11. Then you have your standard deduction. But here's why this is important to understand this is that these deductions are in addition to the standard deduction. They're in addition to the itemized deductions. And softwares are not going to automatically be able to know what the deduction is. There will be a need to inquire of this. So if you are somebody that has clients that are students, or you're a student yourself, or have kids that are students and they're waiters, just take note. Maybe on the W-2, you can just use the figure there, but the employer does need to provide that. Overtime pay is not going to be anywhere on that W-2, as well as the interest. So on the charitable, not going to go through it. You've got the info, but it's because it doesn't come into play until 2026. Now, let's talk about the senior deduction. So it's $6,000 straight up, age 65 and older. So on last day of the year, boom. Now, this does last only through 2028. But the thing is that this is a stackable deduction. So you get it in addition to the other deductions. And this has nothing, hear me clearly, not one thing to do with Social Security income. So if you are now saying, well, but I heard, and do I have to have Social Security income? The answer is no. Here's all you need to know. There's one qualifier. Are you age 65 at the end of the year? Yes, you qualify. That's it. Period. You got both spouses? Great. They both qualify. It's $12,000. When I say it's stackable, it doesn't matter if you're taking the standard or the itemized deductions, you still get that. If you're currently, or they get the uh, additional age 65 and older and the blind, those still exist. This is on top of all of that and not contingent on whether or not you got Social Security. But there is a phase out, okay? So the thing to note is that the phase out is 75,000 single, 150 married filing jointly. So my son Cooper has a client and they just went through the tax estimate, and based on some of the transactions that they're going to have, even though they're 65 and older, they're going to have some high capital gains. They're now not going to be able to see that deduction on the return because it will get phased out. Now, hear me on this, please. Especially you tax advisors, you got to hear this because I've never heard of a phase out that works like this. It's never happened in the history of taxes and it's not good. Okay. But I just want to really make sure you're tuning in that with this, whatever the reduction is, it reduces down both of the spouse's deductions. So hear me on this. If you have two people qualify, married, filing jointly, so they get $12,000. But if the phase out comes into play, the phase out isn't minus the 12,000. The phase out is you take 6,000 minus the reduction for one spouse. You take 6,000 and the exact same reduction for the second spouse. Here's all you got to know. It's basically a double reduction if both spouses are qualifying. So I'm giving you an example there. Go back and take a look at it. Car loan interest deduction. Now, on this one, hey, it's great, but it's really for your personal vehicles because if you have a business, you should be already deducting at least to the business percentage. But that's a key here. Take note. For those that are filing Schedule C, you get to deduct the car loan interest when you're using your vehicle for business purposes. And that's whether you're taking mileage or whether you're doing actual expenses. A lot of people will argue that point. Go look it up. You get it no matter what method you get, because some vehicles would have interest, some don't have interest. Of course, we're talking about vehicles that you own. This does not apply to leases because there's no car loan interest on a lease. So it's got to be a new vehicle. It's got to be manufactured or final assembly in the US. And you bet you can verify that by VIN number. So it's only on new vehicles. Now, it doesn't matter the GVWR, doesn't matter how you use it, because it's just you get that. Now, it is up to 10 grand, but I don't know anybody that would get the maximum unless they had multiple vehicles. So what does qualify? As long as it has two wheels, then it's going to qualify. Now, you guessed it, there's a phase out on this thing, and the phase out is pretty low. Okay, 200,000. So all to say, we definitely want to be aware of that. So used vehicles don't count, leased, ATVs, campers. If it's for business, you're deducting it there. If you're doing it for investment or resale, so if somebody rents out their vehicle, bottom line is you've got to make sure that it qualifies. And again, I told you earlier, the IRS is relieving the responsibility for those companies that are making these loans from having to send out any documentation related to that. So I've got some examples here for you that you can go through if you'd like, looking at the deduction. The only thing is, on average, somebody's buying a new vehicle for 48 grand, and on average, the loan interest is about 8%. So on average, someone's only going to have $2,444 of that interest. But remember, it's not just on one vehicle. So if you happen to have somebody that has bought two new vehicles that would qualify, well, it can, as long as there's not a phase out. So I've given you a link there. You can actually look and see, well, does it qualify? And it's all about that US assembly. So I've put some things in here that you want to make sure that you have for the file or that you're requesting. Tax professionals, we want to update our list so we know now what is it that we're going to be requesting from the IRS. I'm sorry, from our clients, so that we can get returns prepared. So not going to go through some of these details. Now, no tax on tips. I wish they wouldn't have said no tax on tips. It really should say it's a tip deduction, okay? Because that's really what it is. It's a tip deduction. It is not just, oh, I don't have to pay tax on tips, because you still have to recognize the tip income. Now, when we get to a couple slides from now, I want you to focus in. I want you to hear me carefully for those that are getting tips and they're filing Schedule C, because your mind's going to be blown on how it's not going to maybe be a good thing, okay? Hear me on this. Now, any deduction's a good thing, but it's not going to be as good as we think, okay? So you got to make sure you understand it. Please make sure you understand this, because it is not as simple in any way, shape, or form. First of all, we're talking about taxes and the IRS and Congress, but it's not just as simple as, oh, whatever I report in tips, that's what I get as a deduction. So with this, it's only through 2028. It does include 1099 workers, right? So this includes people that are getting 1099s, like Uber drivers. It is cash, non-cash, Venmo, credit card. We know that it does need to be tracked separately. It is up to $25,000, okay? And that is just per return. It's a below the line deduction, so you get it in addition to, but this does not save Social Security taxes. It does not save self-employment taxes. I hope you heard that. This is not a deduction on Schedule C. So they are still going to pay self-employment taxes on this. And with this, if it's filing separately, no one gets the deduction in those circumstances. And there is phase outs to pay attention to. Now, what I wanted you to note here is that it is 25,000 per. And I've got a number of examples here for you. And we don't have time to go through each one because we're just doing this in an hour. We've got 617 slides. I'm just trying to let you know how generous I am. It's the only reason I keep saying that to you over and over. What a guy. What a guy. So with this, here's the thing to note. You have to report it as income. So if you got wages, okay, great. That's going on line 7. If you are on Schedule C, it needs to be included in gross income on Schedule C. Now, before I go through the slides, I want you to hear two things, and one of them is a repeat. This deduction, quote unquote, no tax on tips, is not on Schedule C. So those tips minus then the business deductions allowed on Schedule C, whatever that net is, will be all subject to self-employment tax. But here's the second thing I want you to hear. Here's the second thing I want you to hear. The deduction is also capped at the net income of Schedule C. Now, there's no allocation. You don't have to go, well, how much of my income was tips? How much was not tips to determine your deduction? But it is limited. So I've got a number of examples in here that we're not going to go through, but I've kind of gone through each industry. And the reason I picked these industries is that the IRS literally put, oh, I shouldn't say IRS, Congress put these in the law. So I've gone through and I tried to think of all the different circumstances that we would see in these different categories of how people make money. But also, there are a number of circumstances that you're like, oh man, I ended up not getting the deduction, or I didn't get the deduction that I thought because it was on Schedule C. And if you don't report the tips, so if we know people got cash tips and it's not on line 7, it's not in W-2, first of all, they still got to report it. But then here's the other thing. You ready for this? Whatever the tip tax deduction is, whatever's allowed, reduces down QBI. Okay. So I don't know of a circumstance, but there could be a circumstance. We're not required to take the tip tax deduction. I doubt that we would not want to take it, but my gosh, we got to really pay attention for our Schedule C filers that are getting tips. And for you, if you are a Schedule C filer and you have this. Now, what does employers need to know? Well, here's what employers need to know on the tips. It has to be voluntary, number one. Okay. If they're in an SSTB, they don't get it. The IRS did come out and gave a number of additional uh, uh, guidance, excuse me, on employers. But here's what I want you to know that this is from May 8th. This law didn't come into play until July. The IRS didn't know there was going to be a new law in May or what it was going to be. But what I want you to note is that the IRS has already defined tips years back. There's court cases on what tips are. There's no new definition of what tips are. And therefore, there's no real wiggle room here from trying to invent something that could be tips. And here's what it comes down to, the bottom line, and I've given you some great examples here, is that if it is something that's going to be automatically added and it's not included as a voluntary option, then you're out of luck for it qualifying. So this is now where the IRS has given us the guidance. I've given you a link there. They've given us codes that we will see going into next year. But if you have employers that have tips, well, starting in 2026, which means January 1st, there needs to be separate reporting because it will then be required to be separately reported on Form W-2. So let's talk about the no tax on overtime, and very similar. I don't like that it says no tax on overtime. Really, what it should say is there's an deduction for those that are getting overtime. And I want you to hear me on something. I really hope you hear me, especially tax professionals. We're going to be in a quandary here this tax season because it's not going to be on the W-2. And we're going to be having our clients say to us, are you sure that doesn't count? How come it doesn't count? And they may not even get a statement from their employer. The employer may say, well, I don't even know what you're talking about. I don't have a statement. So the IRS has said that pay stub can be used as a guide, but the IRS says the employee needs a statement from the employer. That doesn't get filed with a return, but we need it in our file. But here's the big thing is that with this, it's still got to get reported in the W-2, still got to be reported in the 1099. But here's an example that there's a lot of confusion on this. Only the half gets included in the overtime that qualifies for this deduction. I just said that quickly. Here's the example that might make it easier to digest. If somebody gets paid $10 an hour and they're working overtime, well, if they're required under the Fair Labor Standards Act to be paid overtime, then it's time and a half. Well, that means that at $10 an hour, they're getting paid 15 an hour. Only the $5 counts because that employee still needs to get paid $10. It's only the Fair Labor Standard Act that requires the additional half or the additional $5 in my example. And so only the $5 gets included in the amount that would then be eligible for the deduction. And I want you to know this is very, very tricky for us as tax professionals, especially for 25, because I want you to keep in mind, we're not lawyers. Okay. You might play one on TV, but we're not lawyers. And this is going to come down to Fair Labor Standard Act. So you need to update your engagement letter just to cover yourself. And all I'm getting at is that if someone's paid overtime, but it's just voluntary, meaning the employer's not required to pay overtime because the employee is exempt from that, but they pay it anyways. The IRS goes, well, that doesn't count. Just because you paid overtime doesn't mean that it counts. And this is not a deduction for self-employment taxes or payroll taxes. So all of that income is still subject to Social Security and Medicare. Of course, we have our phase outs, and married filing jointly can get up to 25,000, but note this, it's 12,500 per person. So if you have someone married filing jointly and you got two people collecting tips, well, that doesn't mean that you get to just get 25,000. It's going to be capped at 12,500 per person. So I've given you some examples there. And what do employers need to know? Well, what they need to know is that this needs to get tracked and properly, and ensuring that only what is included is what is required under that Fair Labor Standards Act. So I've given you some examples here that you can go through related to that. This is unofficial right here. So this is just per me. You don't get to count on any of it. But I came up with a little bit of a list. And you can't just look at one item. So you just got to use your brain on this. Okay. You can't say, oh, well, somebody classified somebody as an administrative, so I guess they're exempt. Wrong. The biggest factor that comes into play for starters is that minimum salary threshold, and it went up significantly 1/1/25. But we don't want to get in the game of figuring that out. Don't get suckered into helping somebody make these determinations because this is employment law and you will get twisted in the wind. Doesn't matter that they don't have anybody else to call. Doesn't matter that they don't want to spend money on lawyers. If they wanted you to cut their hair, I know you wouldn't do it. So IRS relief, it's just they don't have to put it on the W-2, but they do need to provide a statement. All right. On the tax forms, just showing you, here's the W-2, here's the 1099. There's nothing broken out. The IRS made it clear they're not making any changes. Okay, you ready for the wagering losses? Now, this starts in 2026, but it's worth noting it's a two-step calculation. Your losses are limited to 90% of the losses and then limited to your gains. A lot of people are getting this wrong. They're saying, oh, your losses are limited to 100% of your gains. No, they're not. No, they're not. It is very clear in the law, and the law states you get 90% of your losses, and then those losses no more than your gains. So, not going to go through it. I've given you some great details, but this doesn't matter if you're doing session betting, a professional gambler, per person comes into play. So, it's definitely key. Mortgage interest, and then the insurance premium. So, we still have the 750,000 that we have in play that's going to continue, but we do get to deduct mortgage insurance premiums. Now that starts in 2026, so I'm not going to go through that. There's a very low threshold in terms of when that gets phased out. So going to see that out of that getting phased out in 2026. Now, I'm not going to go through this. This is just a regurgitation in my longer version But we're going to see a lot of changes to itemized deductions related to this new law. So, with this research and development, not going to go through that with you just because it's very rare. Now, I want to spend some time on the bonus depreciation. So, on the bonus depreciation, it's acquired after January 19th, okay? Not the first 19 days. It is 100%, and that's permanent. Just want to remind you, you can do bonus or you can do 179, but remember with bonus, it is only class life under 20 years. So if it's over 20 years, it doesn't qualify. Doesn't qualify on residential rental. You don't get to do bonus. And a lot of people out there, and they're just dead wrong. And if you think otherwise, you got to go and research this because with all due respect, you're wrong. But bonus depreciation does not get to take on Airbnb. Period. The end. There's court cases. You don't get bonus depreciation just because it's short-term rental. You don't. End of story. It is crystal clear. And the reasoning is it's still residential. It's classified residential. Period. The end. So if you're using residential rental for bonus, you must stop. Maybe it can qualify for that section 179. Now, 179, we get it back to 1-1, okay? So that could be depending on the first part of the year, how your purchases came out. Now, remember with 179, for year-end planning, roof, HVAC, fire protection, the security, those are 39-year for commercial, 27 and a half year for residential, but those qualify for 179. If you're scratching your head, that's okay, because it was the PATH Act that allows for that, and that has survived all of these new acts. And you do get 179 on that if you elect it. So we want to keep into account that. Listen, I've just given you some examples of class lives, okay? And I've given you some examples on how it works with the vehicles. Not going to go through all that. Just know that when we're now looking at bonus depreciation, we're back to the 100%. Section 179, it's up to the 2.5 million. If it's over 4 million in new assets for the year, then it starts to phase out. And with that, I'm not going to go through much more detail here because I just went through it with you. Now, I did give you some examples on how it works with 179 and bonus depreciation, if you kind of want to kind of think that through. And that's where the strategy comes in come tax season, right? So we have the options we might be thinking through. So the clients that I'm meeting with right now, and they're doing the real estate, we're looking at these items, but we know we do get until the tax time to take a look. On the QBI, it survived. Oh my gosh, I know there's so many people that, not probably tax professionals, but there's so many people I talked to and they had no idea what QBI was. We reminded our clients every year. But what I want you to note is that in 26, there's just a wider threshold. The bracket is wider in when it gets phased out. So it's for 2026. So if it doesn't make sense, I've given you some examples there. We're not going to spend any time. It's just they do have now more they can earn before it's fully phased out, or there's a full phase in of that look, and there's now a minimum in 26. SSTB still the same. The qualification of QBI, nothing changed with QBI. Not going to go through the clean energy, just some various things to note for 1099 reporting. So we're starting right now. Who needs to get 1099s for our clients? We're looking now, right? Because the reasoning is, well, do we have the EIN? Meaning, did the client get the EIN? But when we get to this January, okay, we're still working with $600, okay? The threshold goes up to 2,000 for tax year 26, but we won't see that until 2027, right? Because we're always doing the reporting for the prior year. So in this January, we're still working with the $600 threshold in determining 1099s that need to be sent out for year 2025. So make sure you're paying attention to that. On the employer contributions to student loans, that's been made permanent. We still get that allowed, but there's up to 5,250 that a business can pay towards student loans, including principal and interest and educational expenses. Take note, if somebody's more than a 5% owner, there's some caveats there on whether or not that owner gets to take advantage of this, but it's been made permanent. Also, when we're talking about the child care tax credit, we talked about that it's going up in 26. So just be aware of those things. Meals still at 50%. And with ERC, not going to really spend any time. If you've been around me or my channel, you know that we had a lot of ERC. Here's all you need to know. I've got a summary here for you is this, okay? If they already paid ERC, you got the money, they may audit you, but you don't need to repay it. If you filed for any quarter before January 31st, 2024, meaning you filed whether it's the original 941 or the 941X, but if that was filed before January 30, on or before January 31st, you still get it. The only thing the new law did was if somebody filed for third or fourth quarter 21 after January 31st, they unequivocally don't get their money if it hasn't been paid yet. So third and fourth quarter was the only ones. I don't have time to go through this, but very interesting on the amount of time for assessment and making corrections. So if you've got somebody, definitely circle back to these slides. I bet you'd find it of help. So we got quite a bit there about the ERC that we're not going to worry about covering. There's a dilemma with the statute of limitations. I'll have a video coming out on that, but I'm going to tell you this right now. Check this out, tax advisors. The IRS right here is recommending something that's not allowed by law. And they even say, because this is their direct language, this is a FAQ related to ERC that they came out with March 20. You can find it on the IRS website. But they say, hey, you know what? You're not required to file an amended return. We all know that. But they said, hey, you know what? If you didn't go back, though, and make the correction for ERC, you know what? Why don't you just go ahead and make it in the current year? Very interesting. Will we be able to apply that then to other things? Are we going to be able to say, hey, well, you know, the IRS is telling us that if we don't want to amend it, well, we can just pick it up in a current year. So, anyways, interesting there. Not going to get into philosophical related to this. All right, so new provisions. I'm not going to go through these because we've already talked about them. The premium tax credit. So in my mastermind group, we're wrapping up the tax consulting group. With this, okay, there still is the premium tax credit going into next year. It didn't just all go away. It was, in essence, the enhanced, right? The difference here is related to that 400%. So my point is take a look at that if you have clients that are getting the PTC. I'm not going to go through these new laws because they're not really affecting our year-end planning. Okay. Now, foreign issues. You got foreign issues. You got a bunch of things on the Secure Act 2.0. I'm not going to go through any of that stuff with you, other than I want you to note two things. Make sure you hear this, especially if you're a sole proprietor. Sole proprietors now can set up a 401k all the way to January 15th for the prior year. Okay. Used to be they had to do it by the end of the year. They can set it up and fund it for the prior year and get the deduction. But take note, it doesn't count for the extension, though. They've got to still do that by the end of April 15th for those that are self-employed, filing Schedule C and on themselves only. All right. Let's see. Not going to go through these things. I've just given you a lot more info than you need, but I did want to make sure you noted this. I want you to note this. You ready for this? You might cook your noodle if you've not seen this before. But new, simple IRA, the employer, if they have 25 or less employees, the employees just get to put in more. If it's more than 25 employees, they get to put in 16,500. If it's 25 or less employees, they can put in 17,600. And we know that there's more based on the ages, and there's even more for those ages if they're 25 or less employees. So make sure you're paying attention to that. Make sure you're not missing this tax credit. Okay. There's a tax credit in play that I feel like a lot of people are missing. And it's that new plan tax credit. And a lot of people are like, oh, if we set up a simpler SEP, and there's not going to really be any expense. So why do that credit? But here's what you got to know. If they qualify for that credit, which just means they set up a new plan, the credit that they get for actually putting money into it is massive. It's massive. It's $1,000 per year credit per year employee. And they get it for 5 years. There's a phase down on it. But I give you an example in here of how quickly that adds up. So with this, part-time employees now should just be included across the board if they're meeting those. On short-term rentals, here's what I want you to know when you're doing your year-end planning and if you got a short-term rental, don't be just licking your chops just because you have a short-term rental, because short-term rentals are very, very easily subject to self-employment tax and need to be reported on Schedule C. But here's the thing, and I've given you this chief counsel that we're relying on, and there's been court cases that have referred to it. But here's the bottom line. Just because it's on Schedule C doesn't mean it's non-passive. So we've got to be careful where we're getting our advice, okay? It doesn't mean that it's non-passive. It could be subject to self-employment tax and passive income, okay? So all to say, you just got to really pay attention on these short-term rentals. If you now, I have clients who are like, oh, I want to know how to save my taxes. What can I do? I'm going to get a short-term rental. Boy, you got to be really careful because you don't get bonus depreciation. You just got to look at it carefully. You better spend time on it if you think they do. You better spend a lot of time on that because you're unfortunately off base, okay? Don't see any new changes there. Hey, a couple of things on S Corp comp. This is a great time to reevaluate compensation for S Corp owners going into the next year. Here's the thing. What can the IRS do? Ready for this? All they can do is recharacterize distributions. Now, why I'm saying this, tax professionals, is you know how many rooms I've been and we've wasted time arguing about ridiculous things that, no offense, no tax professionals are sitting around and arguing with their clients and making sure that they're paying enough in salary. You're one in a million if you are. But the reason I'm telling you this is that's not TikTok advice. What I'm telling you is look at your clients' distributions, look at that general ledger. Because this is where, and I know for a fact, the IRS is wanting to see the general ledger detail of distributions. And if those things don't look like payout of profits, that's what gets recharacterized as salary. We can argue all day long, reasonableness and all this stuff. Great, you bet. Go ahead and argue and dig your heels in, make all your opinions. But here's the thing no one's doing. They're not looking at distributions and how often they are because it doesn't matter the percentage. It doesn't matter the comparison. The IRS easily, case after case, is winning by just saying these distributions clearly aren't distributions of profits. They're regular, they're whenever, they're haphazard. It's $20 here, $100 there. It's personal expenses recategorized to distributions. That's where we want to pay attention here, okay? So even if we don't have time to figure out all that stuff, and the IRS is definitely aware of what we're dealing with here, distributions to shareholders, okay? If you're just recharacterizing personal expenses to distributions, know this. Believe it or not, there's cases out there. You're complicit. You've committed a crime. It doesn't matter if you want to go, well, JJ, what do you mean a crime? You've literally committed a crime. You've committed a crime because the IRS is doing this and they are holding CPAs and EAs and tax professionals responsible. They're not even holding the client responsible for this. You ready? Personal expenses paid by any business is taxable to that employee as wages. There are no exceptions. And guess what payroll taxes fall under? The jaws of the IRS, the trust rules, the jaws that they don't hold back. And you now have contributed to absolutely incorrectly having your client pay in the wrong amount of Social Security and Medicare. It is unbelievable, the court case out of California, and they held only the tax preparer responsible for years of this, $100,000 or more, and held the taxpayer, their client, zero responsibility. We just can't look the other way on this anymore. You just can't. How do we rectify it? Make them pay it back. Hey, and make sure, okay, this is probably where we're going to close here. And I'm glad you made it because I'm actually going to do some Q&A with you. I'm going to do some Q&A. So if you have some questions, go ahead and start putting it in the chat. With this, make sure you hear this, please. Make sure you hear this. This is our closing one. But this is where the IRS wins. And they will look if your client does get randomly selected for audited. But on an S Corp, it's the same for partnerships, but on an S Corp, we have to get this done so it's on the W-2, which we know we only then have a couple of more weeks to make sure this gets accounted for. But if the S Corp pays health insurance, dental, vision, long-term care on behalf of that more than 2% shareholder, believe me when I tell you this, it's not a deduction to the S Corp because it's a taxable fringe benefit. And that means this: the only way you get to deduct it is if that dollar amount is included in the W-2 wages of that shareholder. You don't get to do an M1. You don't get to do a K1 adjustment. You do not. IRS came out years ago and said they're not going to allow it. They're not going to accept it. Now, it goes only in box one, so it's not subject to Social Security. It's not subject to Medicare, technically subject to withholdings, but it's not an argument to say where they're going to get the deduction anyway. So don't be the one that your random client gets audited because they're looking at it every single time. Now, I am going to allow you to go ahead and put some questions in the chat if you would like. Wow, we had, I'm surprised we only got 40 on. There must be a lot of people that are coming for the replay because I think we had, um, yeah, we had 198 people sign up. But anyways, so I'm glad you're here because if you're here live, we're going to do some Q&A. But hey, I'm going to share real quick my screen now instead of the PowerPoint because I'm going to skip to just something at the end. If you don't have any questions, then gosh, it was great to have you. Thanks so much for being here. I hope you check out my mastermind. Look at the videos I'm putting on YouTube because I'm putting more up there now. But real quick, I'm going to skip around and I just want to skip real quick and make sure that you saw that I included a lot of these other subject matters. They're more related to tax update, not really year end. You got to pay attention though between the passive and non-passive. The IRS is really spending a lot of time on this. It doesn't mean we need to be scared. We got to be smart, y'all. You got to be smart. You got to look every year at passive and non-passive. You have to look every year. They are finding ways to just go, yeah, sorry, we don't care about a receipt. We don't care that it's a loss. Does it have basis? Is it passive? Is it non-passive? And they're winning over and over and over and over. And the bottom line is we don't want to get caught watching the paint dry on this one. I want you to note real quick, if you have a client and they are filing more than 10 forms with the IRS, okay? My understanding is if they got 5 W-2s, that's 5 forms, okay? They got a W-3, well, that's 6. If they got a 941 quarterly, they're at 10. Well, they got to file everything electronically. And I'm sure they already are, but that's key when we're talking about the 1099s. Hey, so while you're deciding if you want to put some questions in there, just want to let you know I've got the new amounts in here for you for 25 and 26 for the HSA, for the IRA, for the Roth IRA, for the simple plan. And what's key here is we've got to make sure that our clients are adjusting or at least aware that they can adjust up their withholdings for 2026. 401k went up for that. So did the SEP. Now the SEP, we got to make sure that there's enough wages and or there is enough self-employment income to be able to max out. Now listen, I'm got a series where I'm talking about putting yourself first So for tax professionals, I'm going to just remind you of one thing. I'm going to remind you of one thing, and I'm going to say it to you as your advocate. Okay. You really need to let yourself off the hook, and you need to realize there's plenty of other tax professionals out there. You're not the only one, and this is from my own ego having to be broken down with a stroke and unable to eat myself and unable to do math in my head for me to learn this. Okay. If you don't know my story, but here's what I want you to know. You shouldn't be doing their tax returns. End of story. It doesn't matter that you don't think they can go somewhere else. It doesn't matter that they're going to be mad, but the IRS is holding us more responsible than ever. Please don't be the one that goes down because you were trying to be nice. It causes stress. Just admit to your client, it's not my specialty. You want me to have a little fun with you? If your client came in and they wanted a haircut, I can't imagine to please your client, to be full service to your client and say, oh, yes, sir, you would cut their hair. So why are you doing tax returns? Just because you know how to read the instructions, just because they are, and I get it, they're compelling you, but you've got to make sure you know what your expertise is for you and your firm, what your ideal client is, and you've got to make sure that you're spending the right amount of time. Because here's what I want you to know. And I've got a book, if you're not aware of this, that came out here a couple of months ago, and I've got a whole video series where I'm reading it to you on YouTube, all for free. Our client needs one thing from us, a tax return, timely filed, and hopefully the least amount of tax. But they are then having a lot of responsibilities back to us. So you've got to change your thinking, and you've got to understand that your expectations need to come first. I know you didn't even hear me. You didn't hear me because you're a superhero, just like me. And I don't talk about this publicly, but I had another stroke last year, y'all. I lost 117 pounds in perfect health, working no overtime, and still didn't get it right and could have died. We need you here. Your client needs you here past April 16th. Okay. These are also things we talk about in our mastermind. It's talking about in a safe place how to put yourself first. And this isn't just for tax professionals, right? This is for small business owners. So if you want to be a part of something that's different and special, then I'd love for you to be a part of this. So with this, well, if you made it to here, I sure appreciate you. Well, hey, got some links coming up right here. Hope you continue the journey. Talk to you soon.
Next season you survive starts here. I've designed a mastermind to keep you alive, sane, and in control while the rest of the industry burns out. I created this for you. Let's go. Tax season isn't broken because of the work. It's broken because of how we've been trained to think. More hours, more clients, more chaos? No, reverse it. This tax season, members move from surviving to thriving. Take a seat. I help realtors, business owners, young hustlers, tax pros, anyone ready to stop guessing and start winning. This channel doesn't slow down, because neither do you.